banks are dealers in credit, and their balance sheets are leveraged, if you like, on equity. And it's wonderful if you've got, let us say, a 2% margin when you take into account all the costs and all the rest of it between what you lend out and what your depositors get. 2%, fine, gear it up 5 times, that's 10%, gear it up 10 times, that's 20%. I mean, they're trying to get something like 25% return on equity, or maybe even more through this leverage. You can see how they get to that point, if you like. As the economic conditions appear to improve, then they increase their leverage. The other thing that has happened this time round is that as the central banks have reduced interest rates to the zero bound, or indeed into negative rates, what it's done is it's compressed the bank's lending margins, the difference between their asset returns on assets, which are loans, up to whoever, what they give their depositors, if anything. And that squeeze in the margins, their response has been to increase their leverage in order to protect the bottom line. There is a payback at that. When interest rates start rising, as indeed Silicon Valley Bank found out, the whole thing goes into reverse, and very quickly you go bust. And this is how this is going to be dealt with is going to be a very interesting question. I suspect that because a primary duty of the central bank is to protect the integrity of the commercial banking system, the expense of this will be shown in the currency. In effect, the rescue will involve the Fed buying government debt so that it increases its balance sheet, it increases banks' reserves and all the rest of it. Not only that, but there will have to be rescues, which basically involve the printing of money.
Can gold, but especially silver, wrestle free of the constant price suppression or shorting and enter new price discovery?
I think the answer is that you'll continue to get that sort of market behavior so long as we have derivative markets, whether it's futures on COMEX or forwards in London, because that gives huge leverage to people who want to play games with real money. The thing is that these people playing games, they don't actually understand that gold and silver are real money, by law. By everybody's common law, they are up to their necks, if you like, in short positions. They want to retrieve that. They make a lot of money trading it. I mean, don't get me wrong, it's a very, very profitable business. While you're losing, let us say, in terms of valuation on your net position at every quarter or every month, if that's the way you account for it, the profits from trading should pretty much cover it. But I would say that the short positions that they have now, and bear in mind that rising prices just makes the whole thing worse. I would not be surprised if we have one or two of these players getting into trouble. I mean, we're talking about very, very large negative positions on their balances. And if you're a director of a bank, or let's say running the treasury department of a bank, and you're looking at the commitments that you have in these markets, you sort of think, well, de-gear my balance sheet, that's probably where I got to go. I don't think it's easy for the traders, if you like, in the swaps and then the bullion bank traders and all the rest of it. I think they've got themselves into a really difficult position.
At the heart of his analysis is the concept of leverage. Banks are not simply holding money. They are, as Macleod puts it, dealers in credit. This means that they use a portion of depositor funds as a base to extend credit and generate returns. For instance, a bank might have a 2% profit margin on the difference between what they lend out and what they pay in deposits. While 2% might not sound like much, banks use leverage to multiply this margin, sometimes up to 10 or even 20 times. Suddenly, a modest return on equity can become 20% or more. This high level of leverage is a double-edged sword. When the economy is booming, leveraged returns look spectacular. But when economic conditions shift, leverage can lead to rapid losses. In recent years, central banks around the world, including the Federal Reserve, kept interest rates at historically low levels to stimulate economic growth. This environment allowed banks to lend at a higher rate relative to their borrowing costs, effectively compressing their lending margins. In response, banks increased their leverage even more to maintain profitability. But here's where it gets tricky. When interest rates start to rise, as they have recently, this highly leveraged system becomes unstable. The costs of borrowing increase, the value of banks' existing loan portfolios can fall, and many institutions find themselves facing significant losses. Macleod highlights the case of Silicon Valley Bank as an example of how quickly this can unravel. The bank's exposure to long-term, low-interest loans led to a liquidity crisis when interest rates rose, ultimately resulting in its collapse. According to Macleod, this issue isn't limited to one bank or even to one country. It's a systemic problem rooted in the way modern banking operates. As interest rates continue to rise, more banks could find themselves in a precarious position. Central banks like the Federal Reserve, whose primary duty includes maintaining the integrity of the commercial banking system, may ultimately step in to prevent further crises. But these rescues come at a cost, and that cost is often borne by the currency itself. What does that mean for the average person? Essentially, it means inflation. When central banks intervene to stabilize the banking system, they often do so by increasing their balance sheets, buying up government debt, and pumping liquidity into the financial system. This process, colloquially known as printing money, devalues the currency, leading to higher prices for goods and services. In such an environment, preserving purchasing power becomes a priority, and this is where gold and silver come into play. Macleod raises an interesting question. Can precious metals like gold and silver break free from the price suppression often seen in Western markets? The answer, he suggests, lies in the dynamics of derivative markets. For years, prices of gold and silver have been heavily influenced by futures contracts on exchanges like COMEX in New York and the London Bullion Market Association, LBMA. These derivatives markets allow for significant leverage, enabling traders to control large positions with relatively small amounts of actual capital. While this setup is highly profitable for traders, Macleod argues that many market participants fail to recognize that gold and silver are not merely commodities. They are real money. Unlike fiat currency, whose value is backed by faith in government credit, gold and silver have intrinsic value. They have been recognized as stores of wealth for thousands of years, and importantly, are not subject to the same risks as paper currencies. However, as long as these markets continue to rely on leveraged derivatives, price suppression is likely to persist. Looking forward, Macleod suggests that while a BRICS currency may not be imminent, the growing instability in Western currencies could lead to a de facto gold standard. If major players like China and Russia were to peg their currencies to gold, it would create a ripple effect, pressuring other nations to follow suit or risk losing credibility in international markets. This scenario may seem distant, but the signs are there. Central banks worldwide are increasing their gold reserves, and demand for physical gold continues to rise. Macleod's insights underscore the need for individuals to consider tangible assets as part of a diversified financial strategy. As banks continue to leverage credit and fiat currencies face devaluation, gold and silver remain some of the few assets that provide true security. While the timing of a major shift is uncertain, the trajectory is clear. Real wealth lies in assets with intrinsic value.
I mean, the new BRICS currency is not going to happen. Forget it. I mean, it really is. I think we just dismiss all talk about it. If anything happens, it will be as a result of the collapse of our currencies, because our currencies are credit. As someone said before a congressional committee a long time ago, the dollar depends on the faith, if you like, that people have in it, the faith and the credit in the US government. When that collapses, then there may be a change. And I guess that the change will not be a new BRICS currency, but what it will be, I think, is for defensive reasons, China and Russia putting their currencies onto a gold standard. Now, whether they do it properly or not, we'll have to see at the time. I mean, it's very, very simple to do. That's the important thing. Now, in terms of any comparison between the European Union and BRICS, the big difference is that the European Union is a political union, whereas BRICS is in effect a trade union. It's a union based on, if you like, free trade between the members. That's the whole point of it. And principally, it's not just free trade, but also the recycling of investment to improve the infrastructure in these countries, allow for the extradition of commodities and all the rest of it. I mean, for example, the building of a railway from Mombasa on the East African coast all the way through to the Congo is all about shipping out, sort of things like cobalt and copper and all these wonderful things that are being discovered in Congo. And in return, of course, the Chinese, are importing capital in, so the currency thing doesn't really matter in a sense. What they're doing is they're importing capital into places like Kenya, Uganda, Belgium, the old Belgian Congo, the Congo, Central African Republic, and so on. The idea basically being that by improving communications, by opening up the country properly, investing in it, then everybody's going to benefit, including China. The only country with a problem in this, I guess, really, is Russia, because Russia is a huge net exporter of energy in particular and other commodities, does not have imports that match. So she is always having to import other currencies, which is the result, if you like, of her sales of energy in particular. So she's up to her neck in Indian rupees, for example. Now, that's not a very happy situation for Russia. And I think that's why Russia was actually quite keen to push the idea of a gold-backed BRICS trade settlement currency back in August last year, ahead of the Johannesburg summit. But that is now a dead duck. That's not going to happen. If, as I say, if anything happens, it will be as a result of the collapse of currencies in the West.
Macleod's observations raise critical questions for investors, especially regarding how to safeguard assets in a world where banking systems are under pressure and fiat currencies face devaluation. The potential resurgence of a gold-backed currency system, or even a de facto return to a gold standard, adds further intrigue. Macleod emphasizes that the current banking system, highly leveraged and sensitive to interest rate changes, is particularly vulnerable. As rates rise, banks that have expanded their balance sheets during low-interest periods may face serious liquidity issues, as evidenced by the recent failure of Silicon Valley Bank. The system's fragility stems from the structure of modern banking, where banks operate as dealers in credit, relying heavily on leverage to maximize returns on equity. With compressed profit margins due to low interest rates, banks have increased their leverage to maintain profitability, a strategy that unravels quickly when rates begin to climb. The predicament for central banks, including the Federal Reserve, is that their traditional toolkit may no longer be effective in maintaining stability. When banks face a liquidity crunch, central banks often step in to provide emergency funding and stabilize the system. However, such actions typically involve printing money in some form, whether by buying government debt, expanding balance sheets, or increasing bank reserves. While this approach may prevent immediate bank failures, it contributes to inflation and erodes the purchasing power of the currency. For the everyday investor, this scenario spells trouble. Currency devaluation is a direct consequence of central bank intervention to protect the banking system. And as history has shown, fiat currencies tend to lose value over time, particularly when governments resort to money creation to address economic crises. In such an environment, preserving wealth becomes a top priority, and tangible assets like gold and silver, which are immune to currency devaluation, provide a logical solution. One of the most pressing questions Macleod raises is whether precious metals, particularly silver, could finally break free from price suppression. Over the years, Western markets like COMEX in New York and the London Bullion Market Association, LBMA, have used futures contracts and derivatives to influence gold and silver prices. While these mechanisms allow investors to speculate on metals prices without owning the physical asset, they also enable banks and institutional investors to suppress prices by maintaining large short positions. However, this strategy is becoming increasingly precarious. As Macleod notes, rising prices of gold and silver make it more costly for these institutions to maintain their short positions. A significant price increase would exacerbate these costs, potentially leading some large players to exit the market and creating an opportunity for precious metals to trade more freely. In such a scenario, silver could see substantial price gains, reflecting its true market value based on supply and demand, rather than on speculative positioning. Macleod also addresses the much-discussed BRICS currency initiative. While some analysts believe that BRICS nations could launch a unified currency to rival the dollar, Macleod is skeptical. He suggests that rather than a formal BRICS currency, We might instead see countries like China and Russia adopt a gold-backed currency as a means of defending their economies against Western currency devaluation. This shift would represent a major departure from the fiat currency system that has dominated global finance for decades, but it is entirely feasible given the economic and geopolitical interests of these countries. To understand why this move would be significant, consider the historical role of gold. For thousands of years, gold has served as a universal store of value, immune to the policy decisions of any one country. Unlike fiat currency, which is based on trust in the government's ability to manage its economy, gold has intrinsic worth and is globally recognized. A move by China or Russia to peg their currency to gold would signal a commitment to stability and a rejection of the inflationary practices that have characterized Western monetary policy in recent years. From a geopolitical perspective, this shift could weaken the dollar's role as the world's reserve currency. The US dollar currently enjoys a privileged position in global finance, as most international transactions are settled in dollars. This arrangement has allowed the US to finance its debts and deficits relatively easily, as other countries hold large reserves of dollars. However, if a major economy like China were to adopt a gold-backed currency, it would provide an attractive alternative to the dollar for international trade. Countries that currently rely on the dollar might begin diversifying their reserves into gold-backed currencies, reducing demand for dollars and potentially undermining the dollar's value. This brings us to the implications for individual investors. If fiat currencies like the dollar, euro, or yen face devaluation, assets with intrinsic value, such as gold and silver, become crucial for wealth preservation. These metals are not subject to the same inflationary pressures as paper money and have historically held their value even in times of economic crisis. For those concerned about currency stability, holding physical gold and silver offers a level of security that fiat assets cannot match. Silver in particular presents an interesting opportunity. Often referred to as the poor man's gold, silver is both a precious metal and an industrial commodity used in electronics, solar panels, and medical applications. This dual role gives silver unique resilience. It benefits from industrial demand during economic expansion and serves as a safe haven asset in times of uncertainty. For investors looking for a more accessible entry point into precious metals, silver provides an affordable option with significant upside potential, especially if price suppression in Western markets begins to wane. Macleod's analysis also sheds light on the broader dynamics within the BRICS alliance. Unlike the European Union, which operates as a political and economic union, BRICS is a trade-focused alliance that prioritizes economic cooperation and infrastructure development. For example, projects like the railway connecting the East African coast to resource-rich Congo illustrate BRICS' commitment to improving trade routes and facilitating the flow of commodities. China, in particular, has invested heavily in developing infrastructure in Africa, recognizing the continent's vast untapped resources and strategic importance. The primary challenge for BRICS lies with Russia, a major exporter of commodities. Russia's trade surplus, especially in energy, has led to an accumulation of foreign currencies, such as Indian rupees, which may not retain value over the long term. To address this imbalance, Russia has advocated for a BRICS trade settlement currency, possibly backed by gold. While this proposal has yet to gain unanimous support within BRICS, it highlights the alliance's desire to establish a stable and self-sufficient trade network, less reliant on Western financial systems. In conclusion, Alasdair Macleod's analysis provides a compelling argument for holding precious metals in today's uncertain economic climate. As banks continue to operate with high leverage and fiat currencies face inflationary pressures, assets like gold and silver offer stability that is hard to find elsewhere. The potential for a gold-backed currency, whether within BRICS or elsewhere, further emphasizes the enduring value of these metals. For investors, the time to act is now. Diversifying into tangible assets like gold and silver provides a hedge against the volatility of fiat currency and the potential instability of the banking system. As we navigate these transformative times, the wisdom of holding real assets, those with intrinsic value, is becoming increasingly clear. Gold and silver have stood the test of time, serving as stores of value through countless economic cycles, and they are poised to play a critical role in the next chapter of global finance. Thank you for joining us for this in-depth analysis. Stay informed, stay prepared, and consider how precious metals can help you secure a stable financial future in a world where currency and banking systems are constantly evolving. Remember, those who anticipate change and take action are best positioned to thrive, no matter what the future holds.